Chart. In 2012, Bed Bath & Beyond operated more than 1,000 stores across North America, commanded a market capitalization above $11 billion, and held a position so dominant in home goods retail that competitors studied its playbook. By 2023, the company had filed for bankruptcy, closed every location, and erased billions in shareholder value. This is the story of how one of America's most recognizable retail empires collapsed in less than a decade. The beginning traces back to 1971, when Warren Eisenberg and Leonard Feinstein opened the first Bed & Bath in Springfield, New Jersey. The concept was straightforward: offer a deep selection of bed linens, bath products, and home essentials in a warehouse-style format with everyday low prices. The founders identified a gap in the market. Department stores carried limited inventory at high markups, while discount chains offered breadth but not depth. Bed Bath & Beyond, as it was renamed in 1987, solved both problems by stocking thousands of items in each category and maintaining aggressive pricing. The breakthrough came from a deceptively simple innovation: the 20% coupon. Customers could use these coupons on virtually any item, with no expiration date and no meaningful restrictions. The coupons flooded mailboxes, appeared in newspaper circulars, and eventually lived on smartphones. Competitors dismissed the strategy as margin destruction. Bed Bath & Beyond understood it as customer acquisition and retention at scale. The coupons trained an entire generation of shoppers to associate the brand with value, to plan purchases around the discount, and to return frequently. Even full-price transactions became less common as the company effectively reset customer expectations around the coupon price as the real price. Expansion accelerated through the 1990s and 2000s. The company went public in 1992 and used the capital to fund aggressive store growth. By 2000, Bed Bath & Beyond operated 311 locations. By 2011, that number had nearly tripled to 900 stores. Revenue climbed in parallel, reaching $9.5 billion in fiscal 2011. The model scaled efficiently because each store followed a proven formula: large footprint, dense inventory, minimal service, and the ubiquitous coupon. The company avoided expensive mall locations, instead choosing suburban strip centers with lower rent and ample parking. The peak arrived in fiscal 2014. Bed Bath & Beyond reported $12 billion in annual sales and operated more than 1,500 stores across its portfolio of brands, including Cost Plus World Market, Christmas Tree Shops, and buybuy BABY. Market capitalization reached approximately $18 billion in mid-2013. The company had become a fixture of American suburban life, the default destination for wedding registries, college dorm supplies, and kitchen upgrades. Analysts praised its inventory management, store productivity, and fortress balance sheet with minimal debt. But a structural crack already existed, hidden beneath the surface metrics. Bed Bath & Beyond had built its empire on physical retail during an era when store visits defined shopping behavior. By 2014, e-commerce had begun its exponential phase, and Amazon had established dominance in home goods. The 20% coupon, once a competitive weapon, became a liability. It conditioned customers to never pay full price, which compressed margins at exactly the moment the company needed to invest heavily in digital infrastructure, supply chain modernization, and technology talent. The business model that had funded decades of growth now constrained the capital required to compete in a transforming market. Leadership made a series of decisions under mounting pressure. In 2019, a group of activist investors led by Legion Partners, McKellum Advisors, and Ancora Advisors launched a proxy fight, arguing that management had failed to adapt to e-commerce disruption. The activists won 3 board seats and pushed for operational changes. Later that year, the board replaced Chief Executive Stephen Tamares with Mark Tritton, a former Target executive who had led that company's private label transformation. Tritton's mandate was clear: modernize the assortment, reduce dependence on coupons, expand owned brands, and accelerate digital sales. The strategy executed poorly. Tritton cut thousands of national brand products to make room for new private label lines with names like Haven, Simply Essential, and Wild Sage. The company planned to launch 8 owned brands in rapid succession, betting that customers would accept unfamiliar names in exchange for style and value. But Bed Bath & Beyond was not Target. Its customer base had been trained for decades to expect deep selection of recognized brands, not curated assortments of store labels. Simultaneously, the company reduced coupon availability, alienating its most loyal shoppers without successfully attracting a new customer segment willing to pay full price for unknown products. The unraveling accelerated through 2021 and 2022. Comparable store sales declined as customers found the new assortment unappealing and migrated to Amazon, Target, and Walmart for both selection and convenience. Inventory management collapsed, with stores simultaneously understocked in core categories and overstocked in private label goods that were not selling. Suppliers grew wary of extending credit as financial losses mounted. In June 2022, the company reported a net loss of $358 million for the fiscal year ended February 2022, compared to a profit of $768 million 2 years earlier. The board removed Tritton after less than 3 years and began a frantic search for both a new chief executive and emergency financing. By early 2023, the situation had become terminal. In January, the company announced plans to close 150 stores and lay off regional staff to conserve cash. In March, Bed Bath & Beyond disclosed that it had substantial doubt about its ability to continue as a going concern. Suppliers refused to ship merchandise without cash-on-delivery terms. Shelves sat empty. Customers who still visited found a retail graveyard, picked over inventory, closed checkout lanes, and clearance signs covering every surface. On April 23, 2023, Bed Bath & Beyond filed for Chapter 11 bankruptcy protection in the United States Bankruptcy Court for the District of New Jersey, listing assets and liabilities both in the range of $1 billion to $10 billion. The outcome was total liquidation. In June 2023, the company announced it would close all remaining stores and begin going out of business sales. Overstock.com acquired the intellectual property, including the Bed Bath & Beyond name, for $21.5 million with the intent to relaunch as an online-only brand. Approximately 18,000 employees lost their jobs. Shareholders, who had seen the stock trade as high as $80 per share in 2013, watched it collapse to pennies before being delisted and ultimately cancelled in bankruptcy. The aftermath reshaped multiple constituencies. Landlords faced vacant anchor spaces in shopping centers designed around Bed Bath & Beyond's large footprint. Suppliers wrote off millions in unpaid receivables. Customers lost wedding registries and gift cards with no recourse. The buybuy baby chain, once viewed as the company's most valuable asset and a potential standalone business, closed alongside the parent brand. Competitors absorbed market share. But the collapse served as a stark warning that even dominant retail positions built over decades can evaporate in the face of structural disruption. The lesson is not that Bed Bath & Beyond failed to change. The company attempted radical transformation under pressure. The lesson is that business models optimized for one era rarely survive abrupt reconfiguration in another. Bed Bath & Beyond trained customers for 30 years to expect deep selection, national brands, and 20% discounts in physical stores. When management tried to simultaneously narrow selection, replace brands, eliminate discounts, and shift online, it severed every pillar of the customer relationship at once. The gap between what the business needed to do and what its existing model could support proved unbridgeable. Transformation required capital, time, and customer patience. Declining sales and supplier distrust eliminated all three. By the time leadership recognized the strategy was not working, the financial deterioration had advanced too far to reverse. Bed Bath & Beyond's collapse demonstrated that market dominance is not permanent and that the cost of delayed adaptation can exceed a company's capacity to survive it.